Good morning, good afternoon, good evening, wherever you are listening to me. Welcome to another episode of Wealth Building Conference. My name is Oludare Fasola. I want to first wish you Merry Christmas and Happy New Year in advance to all our viewers across the world. I want to also thank you for joining this program. So today is going to be the last episode in 2025. So today is going to be the last episode before we proceed, just the normal way of welcoming ourselves. As you are joining, please, I want you to please type your name and where you are joining from. We just want to know each other. We want to make sure that this program is very interactive. We don't want just to come to just normal webinar and talk. We just want to make it very interactive. Again, if you have any question, please drop it in the comment section. I'm going to attend to your question at the end of the program. And of course, if you know any medical professionals who is looking to build wealth, or they have been working from January till December, but they keep asking themselves, how much do I really keep? Right? This is another opportunity for you to let them join this amazing program so that they can learn on what is actually missing in their finances. Why is money leaking without even noticing it? Because a lot of the times we make so much money, but it's at the end of the day, we don't even know whether we keep so much of what we are earning. So tonight is going to be another eye-opener. Please let them join this link so that we can quickly enjoy this program. Again, for those of us who are also looking to help medical professionals, this is another opportunity for you to come and learn on things that are really affecting them. What are the strategies and how you can also position yourself as a go expert to help them in their finances, build wealth, and of course, create generational wealth. So without wasting much of our time, I'm going to quickly pull up my slide, and tonight we're going to go into the presentation. So tonight we're going to be talking about wealth strategies for medical professionals. Keep more of what you earn through strategic planning, right? I used to say this every time, that it is not about how much you earn, but how much did you really keep? Many people are making so much money, especially medical professionals and business owners. But the question is, how much of what you really earn that is actually stay with you, right? Most times we lose money. There are leakages in our finances that we don't even notice. But at the end of the day, we just realize that we work so hard, we make so much money, but we don't have, nothing to show for it. So I'm going to open your eyes today to understand why it is important for you to plan ahead 2026, so that the 2025, the mistakes you made in your finances will not continue in 2026. But before we proceed, let me quickly make an important disclaimer that this presentation is for educational purpose only. Okay, it doesn't constitute legal, tax, or accounting advice. So individual circumstances differ. So please try as much as possible to reach out to your advisors or accountant or financial planner to help you to put strategic plan in place in order for you to manage your finance. So let me quickly ask you this question. You earn well this year, right? But did you keep enough? Right? Many times we just work, but if you prepare your book of account at the end of the day, all right, your profit and loss on paper, you make so much money, but in your bank account, right, how much of that really reflects in your bank account, right? How much actually stay with you? Like, you make so much money, you make $500,000 in your corporation, you make so much money from your practice, but how much of that did you keep? Especially, you understand that you are exchanging your time for money, right? If you exchange your time for money, you work so hard. How much of this did you keep? So I'm going to open your eyes in this presentation. Do you know that high income does not constitute high wealth? Yes. You make so much money does not mean that you have built massive wealth. It is not the case every time, because many people think that if I make so much money, it means that will give you an opportunity to build wealth. The answer is no. I've seen so many medical professionals, so many business owners, they make so much money, but it doesn't constitute to wealth. In fact, at the end of the day, they even ask themselves question, where is the money? Like, I've worked so hard, like I've made so much money, but I have nothing to show for it, right? Medical professionals earn more than 95% of Canadians. That's very profound. Like, you actually belong to the top earners in Canada. But the question is, how much of that did you keep, right? In combined, right, according to Canadian Medical Association, okay, in combined taxes, if your income is not properly structured, you pay between 40 to 45% in taxes. And of course, if you also make money from your corporations, the passive income is, so you could pop up to about 50 to 53% in Canada. So how do you now make sure that I keep more of what I earn? Income lost to highest marginal tax rate. Your corporation, you pay tax, you pay yourself salary, you pay tax. Your corporation make so much money, retain any, you also pay tax. The problem is not income, the problem is leakage. The problem is not income. Like, I've seen so many people, they make so much money, but they keep more of what they earn, because why? They have a strategic planning for their finance, right? You are a medical professional. You need to sit down and understand that if I don't put strategic, intentional planning in place, I cannot keep more of what I earn, right? Now, let's look where the money really goes. These are the silent wealth killer. Number one, excessive taxation. Personal tax rates eroding income. As I said earlier, you could pay up to 45% in taxes. If you pay yourself salary, you pay tax. If you take dividend, you pay tax. You make so much money in your corporation, like, you pay 12% in Ontario here, other provinces, depending on your province. But also, what about retained earning is also subjected to serious, huge taxation. Again, poor structure, unoptimized corporate income. Many of us, like medical professionals, you can do so much investment. Put money on real estate, you put money on stocks, you put money on so many investment. But how did you structure this investment? How did you structure this investment in such a way that you keep more of what you earn? Corporate funds not working, idle cash. A lot of you have so much money in your retained earnings, but you're afraid of how do you want to actually invest this money? Because why? You know that when you make money from your corporations, like, whatever you make from your corporation, after your corporate tax, the first $500,000 will be taxed probably around 12% here in Ontario. But what about the leftover, the one that actually go to your retained earning? How do you make sure that you put this money into work in such a way that it's going to be safe from taxes and you're going to have enough? Well, you build wealth such that it's not going to be subjected to huge taxation. Wrong vehicle, not optimized investment. Like, see, when you are investing, did you ask yourself, how do I even invest? A lot of medical professionals, I know, they rush into real estate. But before you go into real estate, do you have the structure in place to make sure that even if I put this money on real estate, okay, I'm still going to keep more of what I earn? And again, missing retirement plus estate planning. Like, if you don't have a plan in place, CRA has one for you, and it is always very expensive. You don't see the loss, but you feel the pressure. And you know what? That's why, as we go into 2026, the question to ask yourself is that, how much of what I keep in 2025? If you work so hard, you make so much money, but you don't keep more, right? The question you need to ask yourself is, how do I keep more of what I earn? right? The planning gap. Why traditional advice falls short. This is what your accountant tell you. This is what your financial planner advisor tell you. You max your RRSP. Oh no, you need to max your RRSP, doctor. You need to max your RRSP. Fine, you need to max your RRSP, but also you need to invest more. Oh, you need to put so much money in real estate. You need to put money on other investment. You need to put money on stocks, bonds, other non-regular investment, right? You need to work harder. Oh, you need to work harder in order for you to save more money. And again, you wait until later, like just wait until the end of the year. We need to determine what you need to put in your RRSP, what you need to put in your TFSA. The gap costs you millions over your career. If you don't know, this is what is missing. Number one, control tax timing. Now, this part of this every year, right? You don't need to wait till end of the year before you now begin to look at what are the tax planning that I need to put in place. Your accountant need to sit you down and you need to agree on strategic planning on how do you actually max out all your contribution, and do you actually do more salary? Do I actually do more dividend, right? What is the consequences of me taking salary versus dividend, and what are the strategic planning that I need to put in place before 31st of December? You need to have that in place. Don't wait until 31st of December and your accountant is rushing. You're also rushing in order to close your books. Many of you don't even know. Your accountant just tell you need to do salary. Why do you have to do salary? Right? Oh, you need to do dividend. Why do you have to do dividend? You need to do the mix of the two. You need to do salary. You need to do dividend. What are the benefits of taking these two strategic plans in place? Again, use corporation strategically, right? Many of you, what they know, okay, you need to incorporate your practice. But do you know that corporation is just one out of so many strategic plans to actually save your money from taxes? As a matter of fact, even when you incorporate, do you know that you need to go a step further to make sure that you have a holding company such that all your investment that you make in your corporation, you need to put it into use in your holding company so that when when creditors come, it doesn't subject to credit. It's creditor proof and it's also safe from litigation. A single cases can consume your practice if care is not taken. And I've seen that in many occasions. Why medical professionals, they make that mistakes, they incorporate their practice, but they don't incorporate strategically. It's not about just having your incorporation alone. You must also have a holding company that will hold all your investment vehicle, your retirement planning, your wealth building planning in place, your estate planning. Again, turn income into retained wealth, from every year that your profits flow from your corporation. How do you make sure that you put this into use in your holding company? Plan beyond investment. It is good to invest, right? But do you understand the consequences of taxes you're going to pay at the end of the day anytime you put your money to work? These are the conversations you need to have before the year runs out. These are the conversations you need to have when you sit down with your accountant, with your financial planner, with your insurance advisor. They need to guide you on what you need to do. And if you feel like you don't even know what to do, you can book a clarity call with me and I'll walk you through on what you need to do before the year runs out. This is the real wealth shift doctors make from income to chasers to strategy builder. Number one, tax efficiency first. Guys, you need to understand is that tax is number one biggest destroyers of wealth. If you don't know how to properly manage your tax, it's going to be extremely difficult for you to build wealth. I don't have any problem in paying tax, guys. I don't have any problem in paying tax. I am paying tax, but if I have a loophole, if I have a strategic way of making sure that I reduce my tax legally, I'm going to explore it. And many of you, right? Many of you, your accountant will never open your eyes to all of this. Because why? Your accountant cannot build wealth for you. They can help you to prepare your books. They can do all things for you, but they cannot build wealth for you. It is your duty to strategically sit down and plan your life Structure before product. Like I said earlier, right? Don't rush into begin to put, say, I need to buy real estate, I need to buy this, I need to buy that. This is not, that's not the first thing you need to do. You need to make sure that you have a structure in place. The foundation must be very strong before you begin to put other things on it. Like if you start putting all your investment in your corporation, it's gonna be, you might run into a very serious tax problem. Cash flow control. Do you know that a lot of us make so much money? Medical professional, business owner, they make so much money, but there's not what you call cash flow. See, there's a difference between making money and cash flow, right? Cash flow means that every month, as you are making money, do you really have enough cash to back up your operation? Let me give you an example, right? Every month, let's say, for example, you make $50,000, $60,000 in your corporation, but you are still struggling to pay your salaries, to pay your staff, to pay guys. That's cash flow. So meaning that there's some problem somewhere. It's that you are overtrading or you are mismatching, like, all the expenses that need to come in a month. Some of you are just, as you are seeing the money, you are spending it. But do you really understand that as you are making the money, there must be corresponding expenses that must match up with that income? Do you ever take your time to know that? All you need to do is just to make money. If you make money, do you have the cash flow to show for it? Guys, these are the questions you need to ask yourself as we close 2025. Do I still want to continue struggling with my cash flow in 2026? If you don't put all these places in play, your going concern will be threatening. And trust me, over time, you're going to shut down that clinic. Because why? It is a very important conversation you need to have. Like, I'm making money. Of course, your accountant can help you to prepare your books of account. You'll prepare your profit and loss, your balance sheet, your, the income statement, the income statement. But the question now is that, do you have cash flow to back all the money you are making for protected growth? Like, do you know that if you make so much money and those growth is not protected, it may also lead to serious problem? Many of you, right? The most important asset you must protect is yourself, because you are the one making that money. Now, if, for example, if for some reasons you're unable to go to clinic, you're unable to go to that practice, you can make money. Do you protect your practice? Do you protect yourself from critical illness, from disability? Some of you delay all these things. Like, I've spoke to so many medical professionals. I'm going to talk to my accountant. It's okay, you talk to your accountant, either, the way, just for you to carry them along, that, hey, I need to do this, in case they see those figures in your account, in your bank statement, they know how to treat them. But you don't need to wait, because why? Everybody has their own areas. I am a financial advisor. Your accountant, it's his own job is totally different from my own. So if I'm talking to you, I'm talking from the point of expert as a professional. And unfortunately, I've seen, like, I know a doctor that, because he failed to plan, he failed to protect that practice, he had stroke. And for that reason, he couldn't work again. Don't allow that to happen to you. Many of us, of course, we are planning for tomorrow. We are doing so many things. Many of us are planning to see 2026, but anything can happen. Life can happen. But if you are not well protected, trust me, regret always happen at the end of the day. And we don't want that to happen. So, but please do what you need to do to make sure that you protect yourself from unnecessary disability or critical illness. Plan exit and estate transfer. As I said before, right? As you also working, like, especially as you're planning, as your practice begin to expand, right? Do you know that you also need to plan as your practice expand? Do you need to put strategic plan in place to make sure that if anything happen, taxes, those things you work for, at least it will flow to your generations without any tax consequence, that without incurring huge taxation? How much did I keep protect and control. I need to see, ask yourself that question, medical professional. How much did you keep? How much did you protect? And how much did you control? Do you really have control over your income? What if you could, one, keep more and retain what you earn? This is what I want you to put in place as we go in 2026. Keep more. Retain what you earn. Don't work for CRA. Work for yourself. Keep more of what you earn. Reduce your tax liability. Lower lifetime tax legally. Please see, as we go into 2026, sit down and structure your finance and structure your income. If your income is not properly structured, according to Canadian Medical Association, I repeat it again, combined taxes is about 45%. So, but if you structure it well, see, this is what is it. Because you don't structure it well, that's how you are paying about 45%. But if it is properly structured, you could reduce that to a lowest barest minimum, depending on your promise, depending on your situation. Build wealth. Turn corporate cash into long-term asset. How did you invest your retained earnings? Do you really claim all the business expenses? Many of you are missing, and that's another problem, right? Many of you are missing out on that, right? Did you claim what you're supposed to claim? Many of you are leaving the money on the table for CRA, and guess what? They will take it, right? Do you create retirement strategy for yourself? Like, see, many medical professionals delay retirement planning because why? There's no proper planning. Do you have predictable income that will continue to give you money when you retire? These are the questions you need to ask yourself as we close in 2026. Guys, you don't need to delay all of these. You must have a plan in place to make sure that you have enough money in place to make sure that you for your retirement. Protect estate and prevent erosion, right? There is difference between protections and estate preservation. Like if you protect, you can put, can put disability, critical illness insurance, life insurance in place. But how much of what you work for, right, actually flow to your estate tax free? So that's another conversation, right? So make sure that at the end of the day, if you don't protect all these things very well, you just realize that, more than half of that actually goes to CRA. No extra work. Build wealth without increasing workload. Do you know that there are so many strategies that you can actually explore as you go into 2026? You can monetize your practice as well. As you are practicing, how many of you you realize that you can write ebooks, you can put it on Amazon, and that will be generating extra money for you while you focus on your practice. That will give you another multiple streams of income. Do you really have another strategies in place aside your real estate, aside you buying stocks? Do you know that you can actually do so many other things that will continue to create money for you? Make sure you exchange your hours for don't exchange your hour for money all the time. Like as you're going to clinic, you're exchanging your time for money. But what if you can monetize your skill? What if you can collaborate and come up with plans? Like, you come together, buy businesses with other medical professionals, and that will continue to create, passive income for you. These are some of the things that you need to explore, right? What an integrated plan look like. These are the smart wealth framework I want you to, adopt as you go into 2026. Number one, corporate tax planning. You must have a plan in place. If you don't have that, go and sit down with your accountant and your financial advisors or insurance advisor on what are the things that I need to put in place to make sure that I further reduce my tax in 2026. Investment strategies, like you must have an investment strategies in place, right? Aside your corporation, right? Do you have a holding company that will make sure that everything you've worked for is actually hold in that areas, your real estate, your other wealth strategies and all of that? Do you actually have a plan in place to make sure that you hold those ones from crazy taxes? Do you have risk management in place in such a way that just one single, downturn can actually consume what you want. Let me give you an instance of what happened in the real estate market in the last 3 4 years in Canada. Many people lost a lot of money in real estate. Do you know that at least you must have an investment in place that will put in a guarantee market that come what may, market fluctuations will never affect it. Have you ever thought of that? Because so many medical professionals I know, a lot of them put money on real estate. If you plan your retirement, assuming you retire in the last 2 3 years, and 70 80% of your investment in real estate, what happened? And the market just crashed suddenly. What happened? You must have a strong risk management. You must diversify your portfolio. You don't need to put your egg in one basket, right? Put some in real estate, put one in a market that is guaranteed that even if the market crash, at least you know that this one will not, it's not going to be further. You must also have strong estate planning in place. Make sure that what you've worked for actually flow to your beneficiaries. And you also need to have strong retirement strategies in place in such a way that when you retire, you have predictable income that will guarantee your retirement as long as you live. One, coordinated strategies, not disconnected advice. Why timing matter? Because a lot of times you delay, right? Number one, you lost opportunity. Tax savings opportunity can't be recovered. Once you miss it, like you cannot go back to 2025. No way. Can you go back to January again? You can't go back, but you can start plan something from 2026, right? There's so much missed opportunity. Idle cash cost, corporate cash, compound inefficiency. If you leave idle cash in your corporation, in your holding company, it's just gonna be there. It's time is very important. Like, put it into work. Those cash that you actually leave there without anything, make sure you put it to work, because that's compound. The moment you put it into works, it's going to be compounding, and over time, the opportunity is a massive retirement gap widen quietly over time. So if you delay, right, you delay your retirement planning, and at the end of the day you realize that those times you also take advantage of right now, you can't recover it back. Start early. If you have been delaying that, please, 2026 January, call your accountant, call your financial advisor, start doing something. You don't need to continue to wait. Estate tax grows silently without planning. Like, before, don't wait till December before you start paying your taxes. As you are paying yourself salary, okay, ask your accountant, do I need to take a little bit of dividend to also make sure that I reduce my taxes? If there is need for you to do that, talk to your accountant. Don't wait until 31st of December while you now be rushing and do all of that. You don't need to do that. Again, the best time to plan was years ago. The second best time is now. Start now. Start now. Key takeaway. Number one, income alone won't build wealth. Yes, high income does not translate to wealth building, right? You need to start. You need to be strategic about that. Strategies determine the outcome. Taxes are your biggest expenses. Long-term impact require planning, right? A lot of us, we don't plan, right? We wait. Like, by the time your accountant file your tax, they now send you the tax bills, and if you don't pay it, you start to accrue. That one will start accruing interest. That become a problem. You don't need to wait for all of that, right? Strategy beat effort. Structure before product. Like, don't start rushing into real estate. Don't start rushing into investment. Strategize first. Ask yourself, how do I invest? Do I need a holding company? Okay, the holding company, what are the things that I need to put in place in order for me to make sure that I have a proper structures to save taxes and to build to a tax free, and keeping more matter most. Retentions over acquisition. See, whatever you are actually making right now, the most important thing you need to understand is, how do I build more? How do I keep more of what I earn? So I want to say thank you so much for your time tonight. Thank you so much for joining this program. So, as I said earlier, tonight is going to be the last episode of Wealth Building Conference. Before we start, next year is going to be another amazing year. We're going to plan ahead for that. If you have any question, you can drop it on the comment section so that we can quickly look into that. Any question? Any question? All right. So I want to wish everyone happy new year in advance. Enjoy your holiday season's graces to everyone and see you in 2026. Bye for now. And thank you so much for joining tonight.